Most people here have probably seen the logarithmic price chart of Bitcoin. It's a very common thing you'll see on Bitcoin Twitter, you'll see everywhere else. You see all the highs and the lows. Most people in the world have not seen that chart. They usually look at the linear chart, and it either, at any given time, either looks like an insane bubble or it looks like a broken bubble. And that's how most of the people see it. Wall of just not going to sell. And that's what we're seeing now, that a fairly still modest amount of new capital is coming into the space, but so many of those coins have already rotated to like the diamond hands and away from the fast money. And so I think that's still a cycle we probably have another 12, 24 months of going through.
Lyn Alden begins by discussing the logarithmic price chart of Bitcoin, which is widely recognized within the Bitcoin community, but not well known outside of it. Most people only see the cycles they have personally witnessed, usually looking at a linear chart. To many, Bitcoin either appears as an insane bubble or a broken bubble, depending on the timing of their observation. They often miss the broader pattern of higher highs and higher lows that Bitcoin has exhibited over multiple cycles. Alden points out that each new high and low reinforces Bitcoin's resilience and longevity. While many people have only seen 2 or 3 major cycles, the more cycles Bitcoin survives, the harder it becomes to ignore its persistence. She notes that the third significant cycle, in particular, is crucial in establishing Bitcoin's credibility. Alden emphasizes the importance of long-term holders, or diamond hands, in the Bitcoin ecosystem. During bull markets, some long-term holders might sell to take profits, but during bear markets, the coins gradually move into stronger hands that are less likely to sell. This shift reduces the available supply and creates a situation where even a modest increase in demand can significantly impact the price. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Most people here have probably seen the logarithmic price chart of Bitcoin. It's a very common thing you'll see on Bitcoin Twitter, you'll see everywhere else. You see all the highs and the lows. Most people in the world have not seen that chart, right? So that's in our echo chamber, that's a very common chart to see the long-term price of Bitcoin, especially in log terms. So you can see all the higher highs, higher lows. Most people have not seen that, and instead they only see the cycles that they personally witnessed. They usually look at the linear chart, and it either, at any given time, either looks like an insane bubble or it looks like a broken bubble. And that's how most of the people see it. And so they don't really see those older cycles generally. So at this point, they might have seen the 2017 cycle, they might have seen the 2020 bull market cycle. And for them, there's really only been those 2 cycles. They know Bitcoin's older than that, but they don't really see the price chart in their mind. And I think what catches people is when there's another high and another higher low and another higher high and another higher low, every single one of those is like another point to them that Bitcoin didn't die. And so they don't see like the 4+ cycles. They see, 2 or 3. And the third one I think is pretty important. When you see something not die 3 times, that's hard to really ignore. And so I think that at the institutional level, we're having some discussions with institutions, and those go, I think, a lot smoother than they did a handful of years ago. I think that basically pain points reveal themselves in each cycle, and things get built kind of in response to problems. So it's one thing to kind of look forward and see what problems are going to exist, and there's always people trying to do that, but it's not really until they need the solution do they turn to it. So for example, when there's low fees in the main chain, people don't really look at other layers that much. But then when there's high fees on the main chain, suddenly those layers matter to them, and suddenly there's more people willing to build layers because there's kind of a more clear demand for it. So I think that we're going to see a number of pain points along the way, probably fees being one of the notable ones during manias or during people putting other things on the chain, all sorts of reasons. I think that's kind of one of the things that there's going to be that shortage, and there's going to be a response to it. And to your point, I think that the HODL wave, like the 70% of coins you said haven't moved in a year, that's arguably as big of an effect as the halving that has in every cycle. So for people that aren't familiar with it, during a raging bull market in Bitcoin, generally you see some of those older coins that haven't moved in a while start to come to market. People are up 5x or 10x or more on their investment. some people trim their position, or they want to buy a house and they need a down payment. There's money that starts getting sold as the price goes up, and eventually that exhausts the new demand that's coming in for the cycle. In addition to all the other meme coins and everything else that's kind of soaking up excess demand. But then during the bear market, a lot of the fast money gets out, and over the year or 2 or 3 years, more and more of those coins gravitate into hands that are really not going to sell anytime soon. They're either in MicroStrategy where they're never going to be sold, or they're like in various people that are holding for 5 years or 10 years. They don't plan on selling anytime soon, and then it only takes a very small spark of new demand to come into that wall of just not going to sell, and that's what we're seeing now. That if a fairly still modest amount of new capital is coming into the space, but so many of those coins have already rotated to the diamond hands and away from the fast money. And so I think that's still a cycle we probably have another 12, 24 months of going through. Institutions are made of people. We often describe, there's people and then there's institutions. They're often described as separate buckets. But institutions, of course, are just made of a lot of people in an organized way. And what you generally find when you talk to people at institutions is there's a lot of people in institutions that do get it. A lot of them own Bitcoin personally, even up to the CEO level sometimes. But it's just that it's not gotten to the point where they could bring it or integrate it into their institution yet. They couldn't put it on their big balance sheet. They couldn't put it on their corporate balance sheet, their pension balance sheet, their asset allocation plan. Even though they themselves are like, oh yeah, I own Bitcoin. I just can't give it to my clients yet, or I can't put it on the corporate treasury. And as the asset goes through more positive cycles, as there's more kind of milestones being met, they can start bringing that from their personal account and start actually doing some of the same actions that they've already done personally, just in their institution, in the more professional life, because the asset's gotten large enough, liquid enough, just understood enough that they can bring it to their peers.
Alden compares Bitcoin's potential for institutional adoption to that of traditional assets like Apple stock. Large banks are willing to extend significant credit against well-established assets. Once banks can custody Bitcoin, they will likely start offering credit and other financial services based on Bitcoin, as it presents a lower risk compared to many other assets they currently manage. She notes that the primary barrier to the development of Bitcoin credit markets is the inability of major banks to custody Bitcoin. Once this hurdle is overcome, the extension of credit will be a natural next step. The success of companies like Unchained, which offer Bitcoin collateralized loans, demonstrates the viability of this market. These firms manage risk by holding collateral securely and offering low loan-to-value ratios, ensuring stability even during market fluctuations.
A big bank would give you a $100 million loan against Apple stock over the weekend if you had $1 billion of Apple stock. If you had $300 million of Apple stock, they give you a $100 million loan. Over the weekend, maybe something happens in China, declares that Apple can't manufacture iPhones, and in the morning, Apple stock gaps down. Well, the bank took the risk, not you. And the bank's already willing to take 48-hour or 72-hour settlement risk on all these other securities. They would be taking an order of magnitude less risk with Bitcoin. So Bitcoin de-risks the bank, but the point really is the banks are already taking more risk, and they're comfortable with it. They've got massive balance sheets. They've got hundreds of billions of dollars of equity capital. So the point really is the only thing that's holding back Bitcoin credit markets is the big bulge bracket banks being able to custody Bitcoin. And at the point that they begin to custody Bitcoin, they will start to extend credit as the natural next step. And there's nothing about the asset class that makes it harder for them. It's a better asset for them to extend credit. It's better than the $100 trillion of equity. It's not worse. So I actually think they will embrace it, and their view would be a lot less risk. It's a lot easier to manage. The reason they're not doing it now is not because there's an issue with Bitcoin. It's just they're not able to custody it. And if they can't custody it, there's no handle on it. That's why you don't see that market taking off.
I think there's been good success, for example, companies like Unchained that have been around for quite a while doing Bitcoin collateralized loans. And you mentioned Caitlin. I think a key thing she would point out is the difference between commodity credit and circulation credit, as Mises described it, which is basically whether or not you can then take the capital, the collateral, and rehypothecate it. So in the ones that have been doing this successfully through multiple cycles, the key is that the collateral is safe. They're making low loan to value loans against collateral, and then they're holding the collateral safe rather than lending out the collateral and creating this like big rehypothecated monster that they can't deal with. And so the firms that have done that well, they've been little or no credit losses because it's done prudently. And I think we'll see large and larger institutions get into that over time because it's a loan type that makes sense amid the other loans that are out there.
How many people know what happened in November of 2034? It's an important date, If you pull Clark Moody's dashboard, you'll see that. In November of 2034, 99% of all the Bitcoin will have been mined. And the last 1% comes out over the next 100 years. So for all practical purposes, stock to flow becomes irrelevant. The stock to flow ratio of Bitcoin is infinity in 2034. It's within the tolerance of just random hourly trading of the asset. So it becomes noise. And so you have about 42 quarters, somewhere between 40 and 42 quarters. And if you look at that 40-quarter period, at the beginning of the gold rush, no bank could custody Bitcoin, no institutional investor could buy Bitcoin, no Wall Street trading firm, no investment company could handle Bitcoin, and it was unclear whether that ever would happen. That was a binary. And when those spot ETFs were approved, that created a fire or an avalanche. The genie's out of the bottle. It doesn't matter who's elected president next. It doesn't matter who's the next head of the SEC. It doesn't matter. No politician's opinion, no banker opinion, no regulator opinion matters after that date. That was the most consequential thing that kicked off the gold rush.
Alden highlights a critical date, November 2034. By this time, 99% of all Bitcoin will have been mined, and the remaining 1% will be released over the next century. This milestone will make the stock-to-flow model essentially irrelevant, as the stock-to-flow ratio will be effectively infinite. The period leading up to this date, which she refers to as the Bitcoin Gold Rush, will be marked by significant institutional and financial integration. The approval of Bitcoin Spot ETF marked a pivotal moment in this journey. This regulatory green light unleashed a wave of institutional interest and investment, fundamentally changing the landscape for Bitcoin. Alden argues that after this point, external factors like political changes or regulatory opinions will have minimal impact on Bitcoin's trajectory. The approval of these ETF has set in motion an irreversible process of adoption and integration. Please like and subscribe my channel.